Good morning, friends. This is Rahul Magan here as a Group Chief Executive Officer of Treasury Consulting and also a venture capitalist. Today, we are going to shoot a very dedicated topic from our Singapore office, which is basically what are all the 5 challenges which Basel III is having. The purpose of shooting this video is very simple, that we are in 2019 and a lot of action is happening in the banking domain. That's an unfortunate part, that the countries like India are too busy in doing the election campaign, rather they are not focusing on what's happening in the banking. Before shooting this video, I would like to give you a glimpse that at the end, somewhere at the last quarter of 2020, which is October 2020, we are coming up with MS 610. Which is one of the revolutionary banking protocol which is coming. God knows whether this would be successful or not, because sitting today, I have not saw any consultancy company who is going in the right approach. And hopefully today in the night, we would be shooting a one comprehensive video that what should be the steps consultancy company should take while implementing 610. Then last but not least, we have in 2022, fundamental review of the trading book is coming, and this is going to just hit the financial industry from the bottom. It's just like a quake. It's going to hit from the bottom and it's too harsh. I don't know what would be banking after 2022, but one thing I'm sure, that out of top 500 banks, that's my personal interpretation, nothing to take personally. Out of top 500 banks, not more, not less than 10% of the banks would be history. And Indian banks would surely be history. One fundamental review of the trading book is coming, because it's pretty harsh. Not a single consultancy firm understands fundamental review of the trading book in and out. The reason it is changing very fast. After every second day, there is one or another form of draft which is coming and very difficult to memorize. Today, we are going to shoot about something different which is hitting 2023, and that is nothing but the Basel III revised. Sorry, Basel IV. I call this as a Basel III revised, but that is my interpretation. Actually, when in 2023 Basel III revised is coming, then there are 5 principal objectives of Basel III. Revised is coming, which is increase the level and the quantity of the capital, enhance risk capture, constrain bank leverage, improve bank liquidity, limit procyclicity, and GSIB, global systematic importance banks. We have DSIBs also, domestic systematic important banks. I would like to go one by one, and then we'll throw you some numbers at the end. One is increase the level and the quantity of the capital. Effective 2008, and that is my personal interpretation, effective 2008, central banks across the globe did worse jobs. I repeat, worse job in terms of managing the recession. They just fixed it, they not resolved it. End result, after every second day a recession is coming. Today the bank do not have capital in place. We very well understand that, without quoting the name of an American top bank which is there in the public domain, they have cut short the trading cycle only because of XVAs, which is valuation adjustment. And I hope that our readers know 8 XVAs, which is DBA, debit valuation adjustment, CVA, credit valuation adjustment, MVA, margin valuation adjustment, FVA, funding valuation adjustment, LVA, liquidity valuation adjustment, KVA, capital valuation adjustment, COLVA, collectorized or OIS, and last AVA, additional valuation adjustment. They have missed all 8. So this bank has reduced the level of the trading. You know, I'm from a banking background. We have holistic news about the bank. This bank has reduced the level of trading only because they don't have the capital for that. This is where we are heading. So as far as this goal of Basel III is concerned, increase the level and the quantity of the capital, I strongly doubt Basel III will be able to reach that goal, because what's happening in Europe, you know. I don't think there is any introductory video which is required what's happening in the Brexit and what is the impact on the capital. The banks have reached to a level in Europe that it is do or die. It is just like a cricket match, that in the 2 balls you have to score 12 runs. The only option, you have to hit the 6. If you are not hitting the 6, you are history. That is the only 2 options you have. Similarly, banks in Europe have reached to a level of do or die. I don't know whether after these regulations would come, they would be able to get it or not. They would be able to in the game or not. After 610, I have special respect for 610 only because I think that if this would be successful, and I hope that, being Singapore is a wonderful government, wonderful regulator, wonderful setup, there is no doubt about that. Government of Singapore alongside MAS both will make sure that this would happen at a very successful rate. I'm pretty sure that the other central bank of the globe would replicate that. And first I see in the line is the Federal Reserve, followed by European Central Bank, could be Bank of England, Reserve Bank of Australia, Reserve Bank of New Zealand. I am nowhere having any double question in my mind that no central bank would replicate. Rather, all central banks are waiting to let this happen in Singapore. They wanted to try and test this, and they would surely be replicated. Henceforth, this goal, increase the level and the quality of the capital, I don't think realistically speaking on the ground this is true. We all know that. But apparently speaking on the paper, the numbers might speak different. To be honest, you know the reason. Second is enhance risk capture. This is the second important goal of Basel III for 2023, and I strongly feel that this goal is seriously overstated. We are at that level when the risk is getting very high. Every second day, there is one negative news is coming. Example, CVA, credit valuation adjustment. I'll tell you two stories in the last 3 weeks because I'm a regular watching a lot of newspaper, magazines, we're shooting videos, we have our own banking connects as well. In Tokyo, most of the banks, the worry is CVA. JP Morgan Chase registered an extensive increase in the CVA. I think it is closer by $20 million. I take an indemnification if the number is incorrect because I need to check and recall. And most importantly, Standard Chartered Bank in Singapore registered an exorbitant increase in CVA. If only one CVA can impact the banks, what would the risk profile? I think this has been completely overstated by Basel III. I think the ground reality is completely different. Banks are really not positioned to take any risk. And most importantly, what the internal news which we're getting from the banks is that banks have stopped accepting the credit proposals. So CDS, I was watching one website wherein I got to know that CDS, which is credit default swap, there used to be days in 2008 when the volume of the CDS was $1 trillion in a year, and now you would be surprised to know it has reduced to $400 billion, which is approximately 60% drawdown. So I think this goal has been completely overstated according to me, but Basel has to take up a call. Next is constrained bank leverage. I think this is the funniest goal Basel III has set up. Bank leverage is growing after every second day, and I think we have learned nothing from 2008, that 2008 crash, the sole reason of the crash of 2008 was the bank leverage. The leverage positions was structured in a way that one collapse, and it's a series of collapse. With due respect, what did happen in US when the attacks happened on the World Trade Center? Although I have a deep condolences for the family, but if you carefully look, these attacks on the World Trade Center happened in such a way that, although I'm not an engineer, but they attacked in such a way that they have collapsed some level of the building and rest building automatically collapsed. So nothing much effort has to be done in that regards. Similarly, the bank leverage is now structured in this World Trade Tower buildings when you and it is started hitting now. We know that banks are losing. Banks have stopped taking position. In fact, with due respect to Singapore, what I'm noticing in Singapore right now, without quoting the name of a bank, that the banks have here also stopped creating the new products. Like in 2007, when I started my career in Treasury, I remember that Goldman Sachs, every second day, after second year, we used to get a booklet from the big banks. Like I still have the booklets of the Barclays, the Lehman Brothers, the Goldman Sachs, wherein they used to term this as a structured derivatives booklet. And I still have that. I'm regularly a reader of that. You know, it's not 1 or 2 pager booklet, it's more than 100 pager booklet. And if you read this booklet, you would get to know, boss, and I have a booklet of the Lehman Brothers also. You leave this booklet, you will get to know where the mind is heading. And today, these booklets are history. We're not getting it. It's a complete history. And I don't think there is any Google link that is also available wherein you can download that. People have deliberately phased out from the Google because no innovation is happening. Stating your goal as constrained bank leverage, I think is completely overstated, to be honest. Completely overstated, and I don't think it is happening. Practically, the leverage is growing. Fourth important is the improved bank liquidity. I think except India, the liquidity has improved. There is no doubt. US did pretty well. Europe did pretty bad. Southeast Asia, including Singapore, did pretty well, except few nations like Dubai. Singapore, in terms of liquidity, did very well. So this goal is, I would say, more or less achieved. So this is not far from reachability, it has achieved. That I agree, completely agree. Fourth is limit pro-cyclicity. I completely disrespect that goal. With due permission from Basel 3. There are three kinds of cyclicity which we have. One is pro-cyclicity, counter-cyclicity and cyclicity. So what is cyclicity? You are going with the cycle. How you can get whether the bank is with cyclicity or not, you need to see one factor in the bank, which is the trading income. Now what exactly is happening that JP Morgan Chase or any other bank, Goldman Sachs, Standard Chartered, HSBC, DBS or any other bank, you would just see, you compare their last 5-year annual report and you see the trading income. Once you see the trading income, you will get to know that this trading income is cycle, with the flow, pro cycle, before the flow, or counter cycle, against the flow. I think counter cyclicity, which used to be very innovative, counter cyclicity, which used to be the USP, unique selling proposition of the US banks, counter cyclicity, which used to be the goal of US bank, is history. And this applies to Goldman Sachs also. I don't feel shyness in saying that my favorite bank, Goldman Sachs, is not a counter cycle now. It is pro cycle. And I think here Basel 3 is little wrong. We are not here to promote pro cyclicity. We are here to support pro cyclicity. Because we need to understand that if the trading positions of the bank, the middle office, if they're not pro cycle, see, pro cyclicity and counter cyclicity is not wrong. The question is, they should not be supported by the leverage. I am against the opinion that we should limit the pro cyclicity, rather we should support it. Of course, I am in the favor. And if this is a debate, I would be the very different person, because debate is having two people, one is pro and against. If you are for the motion, you are against the motion. Here I am for the motion. You should go with pro cyclicity, rather you should go with the pro cyclicity, rather you should not against it. But at the same time, having said that, pro cyclicity should not be supported by the leverage. Here I am against. I think this goal by Basel 3, Bank for International Settlement, is not done. This is my personal interpretation. The last goal, and then we speak numbers, which is GSIB, which is Global Systematic Importance Bank, and DSIB, Domestic Systematic Important Banks. I think these are only words now. Global Systematic Important Banks were important in 2008 when the world not saw the deepest financial crisis. Someone great whose age is 35 is now telling you, turning 35 to be honest, is telling you that the next recession is not 6 months far maximum, and this recession will once again originated from banking, like earliest recession. Like 2008, again banking would initiate that recession, but GSIB is only a theory. Sitting today, if you carefully see the stress levels of Goldman Sachs, top 10 banks, Goldman Sachs, Standard Chartered, UBS, JP Morgan Chase, Barclays, say HSBC, Citi, ANZ, Westpac, National Bank of Australia and another, you would get to know that stress levels are pretty high, extremely high, and I don't think that they are GSIBs, because they are limiting their position. Why am GSIB? Let me give an example. Let me talk simplistically. Who matters to you? Bill Gates or a normal manager who is working in any company? Bill Gates. Who matters to you? Donald Trump, American presidency, or Bill Gates? Very challenging question. Some people will go with Donald Trump, some people go with Bill Gates, but very challenging question. Who matters for you? Donald Trump or a normal manager in a company? It's a no-brainer question. It's Donald Trump. In 2008, the banks were in a situation, Donald Trump and Mr. Bill Gates. Very tough to decide whom to secure, whom not to secure. And one of the learning lessons of Lehman of 2008 is that Federal Reserve let Lehman Brothers collapsed. And I would request you to saw several Hollywood movies in that regard. And result is a failure. But this time in 2019, the situation is not Donald Trump versus Bill Gates. The situation is Donald Trump versus an executive or a manager working in a company. So choice is pretty clear. The difference between GSIB and the DSIBs are thinner. I think GSIBs do not matter now. If you even look at Singapore, you have seen that the banks have started stopping innovation. I don't know when was the last time Goldman Sachs came up with a fresh structured derivative product. I don't know when was the last time the banks in Europe, they came up with a product. I think European banks are pretty clear. They are straight. We just need to survive. This is what our view about Basel III, which is coming in 2022. Apart from that, we are here to discuss something very technical, which is an output floor test. Now, this is what we are discussing. The Basel III came up with the output floor test, and that's going to go live in 2023. Basically, it limits the benefits the banks are getting, which they can derive from using internal models to calculate minimum capital requirement. Although minimum capital requirement has completely, the internal model has completely been wiped out now. You are having, basically the advanced measurement approach. Like if you go to 610, check it out. They have clearly stated that internal models do not matter. It's an advanced measurement approach, which is what Basel III is telling. I would like to have few screenshots which I have taken from our presentation because we are not showing a computer here. The revised output floor limits the amount of capital benefit a bank can obtain from using its internal models relative to using the standardized approaches. Banks calculate RWA generated by internal models cannot, in aggregate, fall below 72.5% of the risk-weighted assets computed by the standardized approach. This limits the benefit to a bank using up to 27.5%. Although I have deep interpretation issue in that, and I'm just going to holistically speak my interpretation issue. But before giving my interpretation issue, I have something which is more important. This I have taken from BIS website. BIS is saying that the revised standardized credit approach will applicable 1st January 2022. The revised internal rating based approach for credit risk will again applicable 1st January 2022. Revised credit valuation adjustment framework will applicable 2022. Before moving further, I seriously fail to understand why BIS is not talking about 7 XVAs. Why they are not talking it about? Why they are a little reluctant? One side they are pushing the banks to calculate 7, and one side in 2022 they are coming up with a revised framework of the CVA. I completely disregard that. This is not done. There is a difference between what you are saying and what you are doing. Then revised operational risk framework would again coming in 22, and most importantly revised market risk framework is again coming 22. Then the game starts. In 22, the output flow ratio would be 50%, 23 55, 24 60, 25 65, 26 70. I say if 22 it is 50, the benefit is 50. 100 minus 50 is 50. 23 it is 55, benefit is 45. 24 is 60, benefit is 40. 25 is 65, benefit is 35. 26 is 70, benefit is 30. Henceforth, what I wanted to say to wind up my discussion is that good morning recession. This is I wanted to conclude. We don't have a single bank right now who is ready for that proposal. We don't have a single bank who is able to come in the market and say, excuse me boss, I'm able to compute everything using advanced measurement approach. The ratios which I said started 22, which is 50% and move to 26 to 75%. It's a problem for me because in 24 we will file for the banking license, and God knows if this ratio will go up, then again it's qualified for us also. But anyways, we have still 5 years to go, so let's enjoy, right? Banks are not ready for that. I think output floor test is a good, I would say, idea. It's a good mathematical exercise. There is no doubt about that. But at the same time, Basel need to understand that there are few changes they need, and then we wind up this video. Number one, we don't need revised CVA. We need revised XVA framework. We don't need revised operational risk. We need revised market risk. And last but not the least, the output flow should not be start from 50%, rather it should start from 30-35%. Although I do not have the data, from the banks, but soon we'll have more video on that. With this, Treasury Consulting demystified their opinion about Basel III. This is our personal opinion. We wish all the best to Bank for International Settlement, a wonderful organization, but we need to see how the Southeast Asia, especially Singapore, how the Europe, especially London, Frankfurt and Paris, and how the US, the presidency, Donald Trump, they're going to be taking this challenge. But to wind up this video, this challenge is not easy. This is relatively not at all an easy challenge which it look like. You know my mobile number 919899242978. You know our fixed income platform www.fixedincome.global. Before winding up this video, our magazine, The Maverick Treasurer, is on the way soon, and also we maintain a WhatsApp group wherein we discuss a lot of market eventualities and everything. No law, no boundaries, no regulator. If you think you have credentials, and these credentials you can create something new, you can add to our vision, you're welcome. You just need to WhatsApp me. Don't forget to visit our fixed income platform www.fixedincome.global. Have a great time ahead.